Okay, right, so let's go through this paper. Okay, so it says here you get 3 hours and 15 minutes, but in your exam it's actually 3 hours. Just the 15 minutes is for you to read. Okay, so you won't be able to really go through the paper or anything as such during that time. Okay, so it says here, please note that the real exam is a computer based exam, therefore the questions in this paper version reflect the question formats of a computer based exam. Okay, and then yeah, don't open the paper and all that, fine. Right, so if you look at the first bit, right, the first section A and section B, it's relatively simple. Okay, so let's go through it one by one. While I'm doing the questions, I will kind of explain that area as well. Okay, so it says all 15 questions are compulsory and must be attempted. Each question is worth 2 marks. Okay, so question 1, they're asking the agency problem refers to which one of the following situations. Okay, so this is one of, always in your paper the first few questions will be a little easy, because even the examiner wants you to kind of ease into the paper. Okay, so that's why I always if somebody comes and asks me what's the order we should do the questions in, my suggestion is to always do it in the order that the examiner has given you. Okay, because he has also put it in a way where once you do one theory question, the next one will be a calculation. If it's a long calculation, the next question will be a easy theory question, right? So following the examiner's order itself is a good idea. Okay, unless and until you unless and of course you kind of panic in section C and all of that. If you do that, then might as well do that first, but otherwise doing it in this order is the best approach. Okay, so agency problem, I'm sure you already know this. The owners are different when it comes to a company. Okay, so when it comes to the company, owners are the shareholders. Everybody knows that. Okay, but the people who actually run the company, they are the directors or the managers. Okay, they are the ones who run the company. So the problem is, people who run the company only tend to have more control over that particular company, because they are the ones who are running. Okay, so what happens is they might take decisions, the managers might take decisions that are going to benefit the managers and not the shareholders, which is not really fair, because the owners are the shareholders. So ideally everybody should work for the shareholders' benefit, but sometimes it can happen the other way around. Okay, so that is only the agency problem. So let's see if we have that answer. It says shareholders acting in their own short-term interest rather than long-term interest of the company. It's not the shareholders acting. Okay, it's the managers who are acting in their own self-interest or their short-term interest. So it's not A. A vocal minority of shareholders expecting directors to act as their agents and pay substantial dividends. No, it has nothing to do with majority minority of shareholders, right? Companies reliant upon substantial government contracts such that they are effectively agents of the government. No, definitely not. The directors acting in their own interest rather than the shareholders' interest. That is correct. Okay, directors taking decisions that will benefit them and not the shareholders. Okay. Right, second question is saying the following information has been calculated for D company. Raw material inventory, in Shifa, if you have done the paper, you can mark it right now. Okay, so you can mark it along with me walking through the paper, so it should be easy for you. Okay, the following information has been calculated for D company. We have raw material inventory turnover period, work in progress inventory turnover period, trade payables payment period, finished goods inventory, and trade receivables. So what's the question? They're saying the length of the working capital cash cycle is how much? Okay, so if you want to calculate the working capital cycle, there is an equation. Okay, so we all know that there is an equation. So basically it is the raw material inventory plus the work in progress inventory plus the finished goods inventory plus the trade receivable collection period. From that you must deduct the trade payables payment period. Okay, so the ones that I have marked in red, they have to be added, whereas the trade payables payment period has to be deducted. Okay, so that is the equation. So just a matter of doing that. So 19 plus 14 minus 40 plus 31 plus 52. So that should give me 76 days. Okay. So always remember, it's what we have to pay, right? The payables is what we have to pay now. So that is the figure that will be deducted. Everything else has to be added. Okay. Right. Okay, so most of you have actually attempted it, so I can go ahead at this pace, right? Then it says the purchase price of an inventory item is $42 per unit. In each 3-month period, the usage of the item is 2,000. The annual holding cost associated with 1 unit is 5% of the purchase price. They are giving you the EOQ as well. What is the cost of placing an order? Okay. Now, whenever you see a question like this, the best thing to do is write down, or you type it. In your exam you have something called a scratch pad, right? So you can open that scratch pad and type down the equation that you will be using in this case. So very clearly they are talking about the EOQ, or the economic order quantity, right? They are talking about the economic order quantity. So before I do anything, what I will do is I will write down that equation. EOQ equals to 2 times the cost of ordering into the demand over the cost of holding. So that is the equation that I have to use. Now what I will do is I will figure out what I already have in the question. Okay. So very clearly they have given me EOQ already. Okay. They have given me purchase price, but I don't really put purchase price directly. Then they have given me usage, right? So what is usage? I'm sure you guys know that. Usage is only the demand. Okay, so demand is also given. Then they are saying the annual holding cost associated with 1 unit is 5% of the purchase price. So this cost of holding is also given. It's 5% of purchase price, means that is 5% of 42. Right? So everything is given except for one figure, which is this cost of ordering. So most probably that is what they want you to find out. Right? So if you look at the question also, it's saying what is the cost of placing an order. Right? So that is the figure that you need to find out. Just a matter of rearranging this equation, but you have to be a little careful. Okay, so let's put in the numbers that we know. EOQ is 185. That should equal to the root of 2 times cost of ordering, we don't know, multiplied by demand. Now this demand, guys, I have already told you, this is annual demand. Okay, it is not a monthly demand or a 6 monthly demand or anything. It is annual demand. So if you look here, they are saying 3-month period. In each 3-month period, the usage of the item is 2,000. So that means with every 3 months, the demand is going to be 2,000. So for 3 months, if it is 2,000, for the entire year, it will be 2,000 into 4. Because we have 4 quarters. Over cost of holding, they told me it's 5% into 42. Right? So now you need to rearrange this to get the EOQ. Yeah. Okay, so what you need to do is this root will come onto the other side. 185 will become 185 squared. And then take the answer for 5% of 42, multiply that. And I'm sure you know how to do the rearranging after that. Right? So when you do that, you should get the cost of ordering as $4.49. Now, an exam thing you have to remember is they are telling you to give it to 2 decimal places. One of the papers I got, you had given it to 1 decimal place. You had rounded it to 4.5. Okay. In your exam, you might not get the mark if you do that. Because these are all still marked by the system. It's not marked by a person. Right. So, in the system, they would have only stored 4.49 as an answer. If you put 4.5, you might not get the mark. So, please pay attention to these things that they tell within brackets. Okay. That will be 4.49. You can take this calculation down if you haven't, and make sure you are able to put this equation in your calendar and get the answer. Okay. Did you try it, Harith, the paper?
I'm finishing my studies. After finishing, I will try.
Okay.
Or else I don't have the confidence.
So Afzal, Amruti, let me just check who else is there. Yeah, only Afzal and Amruti. Have you guys tried the paper? Because if you haven't, I will go little slowly. If not, because I know the others have already tried. Yeah, Tarushi, it's not wrong. I mean, now I know it is correct because you can round it up. But like I said, this is marked by the system. It's not marked by the examiner. It's not a human being who is marking it, right? So in the system, they would have saved the answer as 4.49 because they have told you clearly, 2 decimal places. So if you don't put it to 2 decimal places, you will not get the mark because the system won't recognize it as an answer. So yeah, it's wrong. You won't get your 2 marks. Okay, so be careful. You did half the paper, okay. So if there are any of you who haven't done it, you can try it now. I'll give you a few minutes, maybe about 2 minutes before I attempt the question. So you are not completely lost. Okay. So always, Tarushi, only in section C, rounding won't be a problem. Okay, because in section C, anyway it's marked by the examiner, he can see how much you have rounded to, so no problem. But when it comes to section A and B, you have to pay attention to what they're saying within brackets. Okay, they will always be very specific, 2 decimal places or 1 decimal places or the whole number, whatever it is. Okay. Right, so the fourth is saying a company is planning to open a new store in a new geographic location. An initial site evaluation has taken place at a cost of 7,000 and a store location has been found. Okay, so they are trying to open a new store somewhere and they have spent 7,000 as an initial site evaluation. Now tell me, this 7,000, I haven't even read the question, but I'm just asking you, is it relevant? No, because this is what we call a sunk cost. Okay, it's already sunk. You have already, incurred that cost. Now, even if you don't open the new location, you can't get the 7,000 back. Okay, so you have to forget about it. Okay, the new store can be rented for 7,500 per annum. It will require refurbishment at a cost of 310,000. Then they're saying complete the following statements of the following costs, and they're giving you different options, which is relevant for an NPV calculation. Okay, so I already told you this 7,000 is sunk, so that is not relevant. Relevant means it has to be future, incremental, cash flow. These 3 things has to be there. Okay, so if you look at the 7,500, it is the rent cost. Okay, so definitely something that you will incur in the future. Is it incremental? Incremental means will you incur this only if you go for the new shop? That is true. If you don't go and rent the new building, you don't have to pay 7,500, no. So it is incremental and it is a cash flow as well. So yes, 7,500 is relevant. And then they're saying there is a refurbishment of 310,000. Again, it is future, incremental. It is a cash flow as well. So that is also relevant. So 2 and 3 should be the answer. Okay. Okay. Fifth is saying complete the following statements of the following ratios, and they are giving you the options which would be used to assess the liquidity of a company. Take a look. What do you think talks about liquidity? So we have return on capital employed, gross profit percentage, acid test ratio, and the gearing ratio. Okay, good. So ROCE and gross profit percentage, we all know, is to do with profitability. Acid test ratio, we do know that it's also called the quick ratio. It is to do with liquidity. Gearing ratio is to do with risk. Okay, so they are asking me which would assess liquidity of the company. Only the acid test ratios, that is 3. Okay. Right, so now they're giving you a graph. Can you tell me what this graph is actually about? We have seen this before. Can somebody tell me what this graph is about? They have given you no clue. They have not told you what it's talking about or where in the syllabus this graph comes or anything like that. They're just giving you the graph and asking you to correctly label it. So if you don't know that area, you will be lost, right? Where did we see a graph like this? I can help you a little. This dotted line only usually is the WACC. Where did we see a graph like this? Okay, which area correctly? Purchasing power parity theory. Okay, so some of you are saying cost of capital and I'm getting other answers as well. This is the traditional view of capital structures. Okay, so please make sure you learn these areas. Okay, if you don't know where this is coming from, that means you haven't gone through this particular chapter, right? So in the traditional view, we said this is going to be the cost of debt, one will be the cost of equity, okay, and 2 is only the weighted average cost of capital. Okay, so which of the following correctly labels the lines on the above graph? 1 has to be KE, 2 has to be WACC, 3 has to be KD. So the answer there is clearly A. Okay, so what did this theory say? It said that the more debt you take, the WACC will keep on falling because debt is cheaper than equity. But after a particular point, because risk is high when debt is very, in exceptionally high levels, cost of equity also starts rising. So at that point, the WACC starts coming up. Okay, so initially as you increase your debt, WACC will drop because debt is cheaper than equity. But the moment your debt comes to a point where you're 60%, 70% in debt, you're heavily in debt, what happens? The shareholders, they kind of perceive that company to be risky, so they start demanding a higher return. So the moment they start demanding the higher return, KE increases, and as a result, this WACC also starts to rise. Okay, so the point is, we say we have to find this optimal point because at this point only the WACC is minimized. So you have to find out what is that proportion of debt and equity where WACC is minimized and maintain that for your company. Okay, right. 7th is saying a government is looking at assessing hospitals by reference to a range of both financial and non-financial factors, one of which is survival rates for heart bypass operation. Okay, so what are they talking about? They're talking about survival rates. Okay, complete the following statements. Of the 3 E's, economy, efficiency, effectiveness, externality. Now first of all, you can cut off externality because we know that is not an E. It's either economy, efficiency or effectiveness, right? So of the 3 E's, which best describes the above measures? So survival rate, is it economy, efficiency or effectiveness? What do you think? Survival rate. Okay, good. Economy is to do with minimizing your cost. Okay, now survival and cost is 2 different things, right? So definitely not economy. Efficiency is making the maximum out of the input that you're putting. So for example, if you have a doctor, he is coming for 10 hours, make sure that you get the maximum out of that 10 hours. That is efficiency. So that is also not necessarily what survival rates is about. What is effectiveness? They are saying the output of that particular organization should be in line with the overall objective of the company. Now if you take a hospital, okay, end of the day, the major objective is what? People who come, do operation, they should survive, right? If they don't survive, no matter how cheap you are giving the operation, no matter how good your rooms are, all of that doesn't matter if the people are going to come and die, right? So survival rate is definitely one of the main objectives when it comes to a hospital. So this is definitely effectiveness. Okay, so that's how you should be able to figure out which one it will be. Okay, so that's effectiveness. The government in a country is following an expansionary fiscal policy. Okay, so fiscal policy means what? We are going to do something with taxes and public spending. That's only fiscal policy. Expansionary means what? We are trying to increase whatever we are trying to do. Okay, so it has to become bigger than what it is, right? So we'll see what it says. How might this affect many businesses? So they talk about a fiscal policy. A is saying higher taxes, less government contracts being offered, less subsidies and lower demand. Now since they are talking about taxes, definitely this has something to do with the fiscal policy. But is it expansionary? Are we making the economy bigger? Are we, kind of increasing the supply in that particular economy? If you ask companies to pay higher tax, you are not going to give them contracts, less subsidies, lower demand. That means the economy is actually contracting. It's not expanding, right? So they are talking about expansionary policy. This is a contractionary policy. So can't be A. Okay. B is saying lower interest rate. The moment you see interest rate, we are talking about the monetary policy. So that is definitely out. Okay, so definitely out. C is saying lower taxes, increased government subsidies and contracts being offered and a higher demand. So again it has something to do with taxes. So yeah, we are still on fiscal policy. That's fine. And we are lowering the tax. So what happens? Companies, they have more disposable income. So at that point they will be able to invest more. They will be able to, expand whatever operations they are doing. So this is what we call an expansionary fiscal policy. So that will be the answer. D is again talking about interest rates, which is the monetary policy. Okay. Which two of the following are false regarding simulations? Okay, so if you remember what's a simulation, it is kind of like a prediction. We are trying to predict what's going to happen in the future, but by changing different variables. Okay, so we see, okay, what will happen if sales and costs increase? Okay, what will happen if maybe a fixed cost suddenly reduces? Okay, what will happen if interest rate increases? So we will take so many variables that can change at the same time and try to predict what's going to happen in the future. So that is only a simulation. So they're saying which two of the following are false regarding simulations? What do you think is the answer? What do you think is false? Okay, so A is saying they can consider several variables changing simultaneously. That is true. Okay, when it comes to simulation, the advantage is that you can change many variables at the same time and try to see what's happening. This is a disadvantage when it comes to sensitivity analysis. Okay, in sensitivity analysis you can't change many variables. You can only change one at a time, whereas with simulations you can change many variables. So that is true. They have a clear decision rule. Okay, now simulation, guys, it can predict and say this is what will happen in the future, but it can't say this is the decision you should take as a result. Decision making is at the discretion of the person. Okay, the person who is carrying out the simulation, he has to take the decision based on his knowledge. So the system itself doesn't give you a correct answer. Now compare that with something like NPV. NPV means if it is positive, the model itself is telling accept. Right? Whereas here it's not clear cut like that. It doesn't tell you whether to accept or reject. It's up to you to decide whether you're going to accept or reject or do something about that particular project. Okay, so B is actually false. It doesn't have a clear decision rule. So that is one false statement. C is saying they give a better understanding of risk. That is actually true. Okay, because risk is what? Variation. Okay, when it comes to simulation, we try to see how so many variables are going to change, how they are going to vary. So yes, it does give you a better understanding when it comes to risk. Okay. D is saying they remove the need for management judgment in decision making. That is wrong. I told you again, management judgment has to be there because the system doesn't tell you what is right and what is wrong. It will just tell you this can happen. It's up to the management only to decide, okay, are we going to go ahead with this project or is it too risky for us? That is up to them to decide, right? So it doesn't, remove the need for them to put in their expertise. So D is wrong. E is saying they describe a range and probability of possible outcomes. That is true. Okay. So the only two false statements there will be B and D. Okay. 10 is saying which of the following is the correct statement of the conclusion of Modigliani and Miller on the relevance of dividend policy. There was a chapter where we spoke entirely about dividend policy. We said there were three theories. One was relevancy theory, and the residual theory. Okay, so you can have a look, if you want, have a look now and see what Modigliani and Miller spoke about when it came to the relevance of dividend policy. So at this point itself, you should realize that they have given, in this particular paper at least, they have given a lot of weightage for theory. And we have come through 10 questions, 20 marks we have already answered now. Almost, I think only one was a calculation, right, that EOQ. Other than that, everything else was based on theory, right? So when it comes to FM, guys, calculations are important, but that mostly comes in section C. A and B more or less is something to do with theory only. Okay, so don't underestimate theory. That's all I will have to say. Okay. So which of the following is the correct statement with regard to relevance? Okay, so there are three theories. I'll just quickly summarize it for you. Irrelevancy, dividend irrelevancy theory, what it suggests is, they say whether you give a dividend or whether you don't give a dividend doesn't matter. As long as the company is doing well, shareholders are happy. Okay, why? Because if they want money, they will sell their shares and even get that money. If they don't want money and you give them a dividend, they will invest that again in shares. So if they want money, they know how to get it. So it is irrelevant whether you give a dividend or not. Dividend relevancy means we say whatever you are doing, you have to stick to that because of the clientele effect. Okay, because of the dividend signaling. So if you give $100 dividend every year, you need to stick to that. You can't suddenly make it 1,000 one year, make it 500 another year. Okay, that is relevancy. Residual theory is, it says after you have invested in all positive NPV projects, whatever is remaining, you can give it as a dividend. Okay, so let's see which one is talking about relevance. A is saying increase in retentions result in higher growth rate. This has nothing to do with the dividend theory, but what is this theory where they say the more you retain, the more you grow. This is Gordon's growth. Okay, Gordon's growth, G equals BR. They say that the more you retain, the more the company will grow. Okay. B is saying all shareholders are indifferent between receiving dividend income and capital gains. This is dividend irrelevancy. They don't care whether it is dividend or capital gain. As long as they are getting a profit, they are fine. So that is not relevant. So that is wrong. The value of the shareholders' equity is determined solely by the firm's investment selection criteria. That is true. Even if you are giving a small dividend, they don't mind as long as you are properly investing in positive NPV projects. If you are not investing and you are not giving a dividend also, then there is a problem, right? So this is part of the relevancy theory. D is saying discounting the dividends is not an appropriate way to value the firm's equity. They don't talk about that in the dividend policies. Okay, that is completely out. So the answer there will be C. Right, so 11 is a calculation. You can try it out, something to do with the purchasing power parity theory. Try it since some of you haven't. Okay, so it says here inflation in the UK is 5% per annum and in the US it's 6% per annum. Given that the spot rate is currently £1 equals to $1.5, what will a UK company have to pay in sterling in 12 months time to buy a commodity costing $10,000? So if I have to know in 12 months how much pounds I will have to pay, I have to first of all know what will be the exchange rate in 12 months. Today I know it is 1.5, okay, but in 12 months how much will it be, right? So the future spot rate, I can calculate it using the purchasing power parity theory. They give me inflation. Okay, so the future spot rate S1 will equal to the current spot rate, which is 1.5 into 1 plus inflation in the counter currency. So we are based in UK, counter currency is the US. In the US, inflation was 6% over 1 plus inflation in the base currency, which is our country. In the UK, it is 5%. Okay, so that will give me the future spot rate, which is 1.5143. So that will be the spot rate in 12 months time. So if I have to pay $10,000, how much will that be in pounds? It will be 10,000 divided by this 1.5143. So in pounds, I will end up paying 6,600. Here also careful, they are saying answer to the nearest Great British pound. So you don't have to put decimals, right? So it will be 6604. Okay. Take it down if you haven't. So guys, it's high time you all started questions, okay, because no matter how much you study, it won't help, okay. After you study also, there will be much more to learn from the papers. That base that you get from the studying, you have to get over with that very quickly. The more time you spend studying, the less time you're going to get doing papers. With FM, papers is only key.
To start papers, to do study hub or study exam?
Whichever one you're comfortable with. Now the thing is, study hub, you don't have that many MCQs. Okay, so either way, whatever you do, that is up to whichever one you're comfortable with. But the point is, you need to start the papers. Okay, because don't think that after you've properly finished studying, you will be able to do the papers 100% properly. You won't. You will find so many problems. So you need time to sort out those problems. So no matter how hard you study, no matter how well you know all the theories, when it comes to the papers, the way they question is different, no end of the day. Okay, so even if you have half studied, it's okay, but you can't half do the papers and go for the exam. You will be completely lost. Okay, so get over with the studying as fast as possible. Even if you have to look at the book and answer, I don't mind. At one point, it will stick to your head. But questions, you have to break that fear. Because this batch, honestly, I have seen that where all of you have a fear to start the question. Okay, don't have that fear. If it's wrong, you tear the page and start again. That's about it, right? But don't have the fear to start the question, because then when are you going to break that? After you break that only, you can even think of, learning from the question. Okay, because trust me, there is a lot to learn from the papers, not from the study text or the book or the slides or whatever. The papers only will teach you more. So for that, you have to give it enough time. If you don't do that, you will end up only doing half. You will only know about 60% of the syllabus. You will have to go to the exam and figure out the other 40%, which is a bad situation to be in. Okay, so get this over with. Papers have to start immediately. In fact, I feel it's a little too late at this point also. Okay, so it's 10 days after now November, 10 days are gone. You only have about 20 remaining. So make sure you use that time properly and start off your papers. Don't be scared if a question is wrong. If it's wrong, you can learn how to make it correct. But until you break that barrier, until you start the question, you are not going to learn from that particular question. Okay, right. So we have the 12th one. Which of the following best describes murabaha as a source of finance within the Islamic banking model? Okay, so murabaha, if you remember, it is trade credit. Okay, it's trade credit. It's like taking a loan. Okay, so it says a form of equivalent trade credit or loan, that is only murabaha. Very straightforward. If you knew that particular area, this is just an easy 2 marks. An equivalent of lease finance is actually ijara. A special kind of partnership where one partner gives money to another for investing in a commercial enterprise. So this is a situation where there are 2 partners. One partner is giving money, the other partner is giving his expertise. Okay, so if you remember, this is actually called mudaraba. So don't confuse the terms, right? Because they asked for murabaha, not mudaraba. So sometimes you might, use it interchangeably, which is wrong. So C, they are talking about mudaraba. D is saying a relationship between 2 or more parties who contribute capital to a business and divide the net profit and loss pro rata. Okay, now remember, in mudaraba, one person gives 100% of the finance, the other person is going to run the business on behalf of him, right? But when it comes to musharaka, both parties will contribute some particular percentage when it comes to capital. Okay, so this is musharaka. I know everything starts with M. Okay, so that is musharaka. It is the equivalent of venture capital. Okay, so anyway, the question is asking for murabaha, so that is going to be straightforward. It's A. Okay, right. 13 is saying comment on the validity of the following statements in relation to the efficient market hypothesis. What do you think is the answer there? So when it comes to efficient market hypothesis, there are different kinds of markets. We have inefficient market, then we have a weak form efficient market, semi-strong and strong. Okay, so we went through this, I think, at the very beginning of our syllabus, right? So let's read through. Statement 1 is saying an inefficient market is one in which the value of securities is not always an accurate reflection of all the available information. That is true. Okay, if you are inefficient, the share price is not reflecting the information that is available properly. Okay, so that is only the inefficient market. Statement 2 is saying in a semi-strong form market, the share price incorporates all past information and all publicly available information. That is also true. When it comes to semi-strong form market, we are going to reflect past information and public information. Strong means past information, public information plus private information. Okay, so semi-strong form, what they are saying is correct. So both statements seem to be true, which is A. Okay, so inefficient means it's not reflecting any information. Weak means only it reflects the past information. Semi-strong means it reflects past plus public information. Strong means past, public, private, everything is reflected. Okay, so that will be A there. So 14th is to do with expected values. Okay, you can try it and see if you can get the answer. It's saying using expected values, which one of the following would you recommend for DPLC? So you should first of all get the expected value. After that we can decide which one is the better project or product in this case. Try it out. So throughout in section A we have only had 3 calculations. One was an EOQ, the other one was a purchasing power parity, and now an expected values. Other than that, everything else has been theory. Okay, so it says here D PLC is considering whether to make product X or product Y. So he can either make product X or product Y. The production of the products is mutually exclusive because they use the same machinery. So if you do X, you can't do Y. If you do Y, you can't do X. One of the two you have to decide. The estimated sales demand for each product is uncertain, and the following probability distribution of the NPVs for each product has been identified. So they are giving you the NPV and they are giving you the probability of getting that NPV as well. Okay, so they are saying product X, the NPV can be 3000 and the probability is 10%, or it can be 3500 and the probability is 20%, or 4000, and it goes on like that. Likewise, for product Y also they are giving you the NPV and the probability. Using expected values, which one of the following would you recommend for D PLC? So let me get the expected values first. How do you do that? You have the NPV and, right? So I have told you, whenever you are doing expected values, when you are using the word and, you have to multiply, right? So it will be 3000 into 10%. 3520%, 4000, 4500 and 5000, all you have to multiply with the probabilities. Right, so 3000 into 10% will be 300. Give me a minute. Just put it as expected value. 3000 into 10 will be 300. 3500 into 20% will be 700. 4000 into 40% will be 1600. 4500 into 20% will be 900. And 5000 into 10% is 500. So the total expected value for product X, you can add it up, it will be 4000. Okay. So same thing you need to do for product Y as well. 2000 into 5% will be 100. 3000 into 10% will be 300. 4000 into 40% will be 1600. 5000 into 25% will be 1250. And 6000 into 20% will be 1200. So you can get a total here which is 4450. Okay, so one is 4000, the other one is 4450. According to expected value, you should go for the higher option. So you will choose product Y, which is B. Simple. Okay. Right, so if you have taken it down, you can try out the 15th one, the last one. All of the following that can be manipulated to affect the monetary policy except which two? It's about monetary policy. Inchifa, did you send me the paper, or did I somehow miss it? You have sent it, or you have emailed it to me, is it? So I don't have it, Inchifa. When did you send it to me? It's not really BNE, correct. Okay, anyways, once you're done marking, let me know, okay, how much you get. Okay. Right, so they're saying all of the following are variables that can be manipulated to affect the monetary policy except which two. So if you're talking about monetary policy, we're talking about money supply and we're talking about interest rates, right? So anything that is not to do with money supply and interest rates, it's the answer. Okay. So A is saying credit restrictions achieved via the banking system. If there is a restriction, you are restricting the money supply. So you are restricting the monetary policy. So that is correct. Government expenditure on goods and services, we all know that is a fiscal measure, that's fiscal policy, right? So government expenditure definitely cannot be manipulated if you are going to affect the monetary policy. So B will be an answer. Volume of money in circulation, that is also part of monetary policy. The rate of interest also part of monetary policy. Taxation is part of fiscal. So B and E is actually fiscal. So that's why it is the answer. Okay. Right. So that is it for section A. Okay. So it will be like the short questions most of the time, focusing on the theory based area. So by the time you are done with this, you won't even be tired in your exam. That's why I told you try to do it in the order that the examiner is giving you, because you wouldn't have broken your head too much. Easy 30 marks you would have somehow been able to get. So if you can get somewhere between 20 to 30, you are good. Okay. Right. So section B, basically you have 3 questions. Okay. You will have 3 questions. And most of the time, I am not telling you it's going to happen always, most of the time one of them will be from risk management. Risk management means foreign exchange and interest rate risk. Why is that the case? Because they can't ask much to do with risk management in section A because it's a little lengthy. But they can't ask in section C also because they have told us they won't ask. Okay, so the only area where they can ask a little bit of risk management is section B. So you can expect one full question to come from that particular area. Other than that, others, anything can be tested. Investment appraisal can come, cost of capital, business valuation, anything can come. Okay, right. So it says here, section B, all 15 questions are compulsory and must be attempted. Each question is worth 2 marks. So 3 major questions, each question is worth 10. Inside that, in every question you will have 5 smaller questions, and each of them will be worth 2 marks. Okay, right. So I'll give you a minute, go through this scenario and then we will attempt it. Okay. So from the answers I saw, section B wasn't as, in terms compared to section A, it wasn't as good when it came to your answers. So this question is clearly from working capital management. Okay, go through it. I'll give you maybe about 5-10 minutes. Go through it and see if you can get your answers, and then I will discuss. Okay, so let me read through what it says. It says JCO Limited has decided that it needs to improve its cash position. The finance manager has targeted a reduction in the time taken for customers to pay and is considering various options. Okay, so if you want to improve your cash position, one thing is tell your customers to pay early. So that's what they're trying to do. It currently has a 4.5 million balance on receivables and a 82-day average time period for receipt of cash from customers, right? So currently what is my receivables balance? 4.5 million, and the receivable days is 82 days. That is the average time period. So receivables and receivable days I have. Its annual sales is 20 million. Obviously I will need that figure. And the business has an overdraft currently charging a rate of 8%. That means the current interest that you are paying is 8%. Okay. So this is the current situation. An invoice discounter offers to help JCO collect cash faster for a fee. They promise that with their help, 60% of the sales will be collected in 30 days and the remainder in 60 days. Now usually it takes me 82 days to collect my money, right? But now this invoice discounter, he is coming and saying 60% of the sales value I will get in 30 days, the remaining 40% I will get in 60 days. So overall the entire sales I am getting it earlier than what I am currently getting. Okay. JCO is also considering using the offer of a settlement discount to customers to encourage them to pay more quickly. Customers will receive the discount if they paid in 30 days. So they have two options. Either go with the invoice discounter, he will make sure that everything is paid within 30 or 60 days. Or they can go for another option, which is to give the customers a discount and tell them if they pay early, within 30 days if they pay, they will get a discount. That will kind of provoke the customer to give the money quickly. JCO's other option under consideration is to use a debt factor agency. So three options. One is go for an invoice discounter, two go for an early settlement discount, three go for a debt factor. So they have to decide which one works well for that particular scenario. Okay. So 16 is asking what would be the annual saving in the cost of financing. Cost of financing means it's the interest cost. If the business could reduce its receivables by half and at the same time move to a better overdraft with a rate of 6%. Okay. Now they are saying currently you have an interest that you are paying. Calculate that somehow. Then they are saying suppose I reduce my receivables by half. So it's 4.5 now, it becomes half of that and I get a better interest rate of 6%. Then obviously the interest charge is different now. Then they are saying compare the new interest with the old interest and see how much you are saving if you could strike this deal. Okay. So two steps here. One, you have to find out what is the current interest rate for the overdraft. Second, you have to find out what will be the new interest that you are paying if what they are mentioning happens. Okay. So try it out and see if you can get the two figures. I don't think anybody got this answer. Okay, so your current receivables is 4.5 million. They have not paid you, right? Now because they didn't pay you only, you had to go for an overdraft. Okay, so that entire 4.5 million currently you will have to take a overdraft and you will have to pay an interest on that overdraft of 8%. Okay, so your interest cost currently is 360,000. Okay. So So why did you take the overdraft? Because their receivables didn't pay you. How much was the receivable balance? 4.5 million. Okay. Now let's see what happens in the new scenario. So new overdraft. So they are saying what would be the annual savings if the business could reduce its receivables by half. So this 4.5 million, you have to reduce it by half. So only 50% I have to take. And you are going to move to a better overdraft rate of 6%. So all this while we were calculating based on 8%. They are saying we can get an overdraft rate of 6%. Okay, so 4.5 into 50% into 6%. The new interest will be 135,000. So earlier I used to pay 360. Now I am paying 135. The net savings is basically the deduction of the two figures. So 360,000 minus 135,000, 225,000. That is only the savings. Okay, it's a simple question. You just have to have the courage to start. Okay. Take it down because I have to erase that before I do the next one. Okay, right. So 17 is saying what would Jayco's new average receivable balance be to the nearest 1,000 if it used the invoice discounter and cash came in at 30 and 60 days as promised. So they are talking about this situation, this invoice discounter story. Okay, so what did the invoice discounter tell? He told me that 60% of the sales will come in 30 days, remainder will come in 60 days. Okay, now they are asking me what will be the receivables figure. Now receivable days figure is easy for me. 60% into sales, 60% will give in 30, 40% will give in 60. I know how the receivable days will be. Okay, but what is going to be difficult is to find the receivables figure. So how do I go about that, right? So again there is an equation like this, right? I am sure all of you know it. Okay, so there is an equation that goes like this. Yeah, so we know that receivable days equals to the receivables over the sales into 365. That's how we calculate receivable days, right? Just give me 1 second. Hello? Yes. Yeah, it's available. Okay. Right. sorry about that. So I have the receivable days, that will be receivables over sales into 365, right? Now they are asking me for receivables. So what I can do is I can rearrange this equation. Okay, so what I will do is I will make receivables the subject of the formula. So receivables will equal to the receivable days over 365 into sales. Okay, so I am just rearranging the equation. Into sales. Okay. Now, if I can use this equation to try to figure out the the new receivables, that is basically my answer. Okay. Now the thing is, when it comes to these receivable days, there were 2 days. One was 30 and another one was 60. So now what I have to do is I have to find the receivables when they give it to me in 30 days and the receivables who's going to give it to me in 60 days. So there will be 2 separate calculations. Okay. So let me do it one by one. So one is the 30-day receivables and the other one is the 60-day receivables, right? So for 30 days, what will the receivable days be? Obviously it will be 30 into what is the sales figure. In the question they give me the sales as 20 million. So into the sales, which is 20 million, into what percentage will give me that 20 million in 30 days. They told me 60% of my sales only will come in 30 days. So that will be 60% over 365. Right? So 30 over 365 into the sales figure, which is 20 million into 60%. So that should give me the receivables in 30 days. Okay. So put that in your cal. You should get 986,301. Okay. So same thing you need to do for 60 days as well. You can try it out and see. Okay, so if you look at the 60-day cycle, receivable days will obviously be 60 in this case. Sales will be 40%, right? So 20 million into 40% over 365. So that should give you the new receivables balance. It should be 1.315068. $1,315,068. Yes, I am just rearranging the equation because I have receivable days. I can find the receivables figure that they are asking. So then what was the question? They are asking new average receivables, no? So just a matter of adding these two together. Okay, so that will be 986,301 plus 1,315,068, which will give me 2,301,369. They told me to the nearest 1,000. So yeah, the closest answer that we have is 2,301,000. Answer is already there. It's just a matter of selecting. Okay, is it clear how you got it? Got it? Okay, so answer is D. 18th is saying complete the following statements the effective annualized cost to one decimal place. So again, one decimal place means you have to give it to that 1 dp of JCO offering a 1% discount to their customers, and all customers took up the offer would be how much? So they're saying what is the annual cost if this company gives a 1% discount and all their customers took up that discount. So when all the customers take up the discount, if you remember, there is an equation that you can use to get your annualized cost. If 60% took it up, 40% took it up, you have to do cost versus benefit analysis, right? But here, since everybody has taken it up, we don't have to worry, you can directly use the equation itself. So the equation goes like this. The annual cost equals to, if you remember, 1 plus the discount over the amount left to pay to the power of the number of periods minus 1. Okay, how do we calculate the number of periods? This all is part of the slides, right? You can either use months or days or weeks, but in this case I think they're talking entirely in terms of days, right? So we will have to use days. So it will be 365 over number of days earlier the cash is received. Okay, so first thing is you need to calculate the number of periods, right? So that will be 365 divided by the number of days earlier the cash is received. So if you look at the discount, they're saying JCO is considering using a settlement discount to encourage them to pay more quickly. They will receive the discount if they paid in 30 days. So earlier they were taking 82 days to pay, now they are going to pay in 30 days. So how many days earlier are they paying? 82 minus 30. Okay. So that will be 82 minus 30, which is 7.02. So now we have the number of periods, just a matter of putting it in the main equation. Okay, so I'll do that over here. 1 plus discount was 1% over amount left to pay. You can consider a $100 invoice. So in a $100 invoice, if $1 is a discount, you have 99 left to pay. Over number of periods is 7.02 minus 1. So that should give me the annual cost, which will be 7.3%. Okay. So the key here is that they told me everybody took up the discount. If they didn't tell me that, it wouldn't have been as easy. Okay. You can take it down because I think most of you didn't get this. This is the 18th one. Okay. Okay. Right, so let's look at the 19th one over there. Which of the following is not true about debt factoring? Okay, so debt factoring is where another company will take up the credit control of our company. So they will call our customers, they will make sure that they pay on time. Okay, so A is saying debt factors can take over the credit control function. That is true. Basically, one of the things that they do is they take over the admin part when it comes to debts. So that is actually true. It's not true. So that can't be an answer. Customers will be unaware that the supplier uses a debt factor. Is that true or false? If you are going for debt factoring, will your customers know that a debt factor is now involved? They will know. Okay. Invoice discounting, they won't know, because you deal with the invoice discounter, take the money in advance, you finish off the deal with the invoice discounter. But when it comes to factoring, it's not like that. The moment the factor takes over, the factor will start calling your customers. Okay. So what happens? Customer has to deal directly with the factor and not you anymore. So that is actually true. So here they are saying customers are unaware, which is false. They will become aware of the fact that a factor is now involved. So that is the answer. Right. Let's see the others. Factors can take responsibility for unpaid debts under non-recourse arrangement. That's true. You can get insurance as well from factoring. Factors can offer credit insurance. Yes. Okay. So that is all correct. The only thing that's wrong is B. 20th one. Which of these is not a key aspect of credit policy? So when it came to credit policy, there were 4 different things that you have to look at. Let's look at what they are saying here. Setting credit limit for customers, that is part of credit policy. Invoice promptly and collect overdue debts, that is also part of the credit policy. Offer discounts to speed up cash receipts. Offering discounts is not part of credit policy. Okay. Assessing creditworthiness is also part of credit policy. So the only thing that is out is C. Okay, so you have to go through that. There were 4 things that we spoke about. One was doing a creditworthiness, then setting credit limits, invoicing promptly, and finally making sure that every now and then you keep on rechecking and making sure that the customer is still creditworthy. Okay, right, so that is that. Okay, so now if you look at the next question, when I look at it itself, I can see that it has something to do with business valuations. Okay, because they are giving me ordinary shares, earnings per share. Okay, then I can see a lot of dividend rates. There is a WACC. Okay, so go through what they are saying. 21 is asking you for a suitable earnings figure. So definitely something to do with that business valuation area. Okay, this particular area, again and again I am telling you, only if you do questions you will get the hang of it. Okay, because the way they teach it is different, the way they question it is a little different. So the more questions you do, only you will get comfortable with this particular area. Okay, I have a quick read through and then we'll do the questions. It looks difficult, it's a very easy question. Okay, it might look difficult, it's a very, very easy question. Okay, so let me read through. Saying AJP company is an unlisted company. Okay. The owner and manager of the business is approaching retirement and is considering the sale of his business. Okay, so all these days it has been like a sole trader. Okay, there is one owner, he is only running the business also, but now he is going to sell the business. Okay, financial information is as follows. We have 5,000 ordinary shares, latest earnings per share, the EPS is given $7. Estimated equity beta 1.5. Latest free cash flow available to the owner is 33,000. That means after all the costs have been settled, 33,000 pounds is available for the owner or the shareholder. But be careful, they are saying it's after salary payment. Okay, now for him, his salary is also considered part of the cost because he was the manager now. Okay, but suppose he was a normal shareholder, he was not a manager, then whatever salary component also will be considered part of the cash flow, because then that will be added to this 33,000. Okay, so it says here the owner and manager pays himself an annual salary of 200,000, which is 60,000 more than could be reasonably expected for such a role. Now if I take another manager and make him do the job of this owner, I will pay him only 140,000. Okay, I will only pay him 140,000 per year. But here, because the owner and the manager is the same, he is taking a little extra. He is taking 60,000 more. So this 60,000 actually belongs to the shareholder in future. Because in the future, we won't pay this amount. We will only pay 140,000. Okay. Other relevant information. Range of listed company PE ratios for companies in this sector. So I have told you, when you are doing business valuation using the PE ratio method, you have to take a proxy company's PE ratio if it is unlisted, because unlisted companies don't have a market price per share. Okay, so they are telling me similar companies PE ratio will be within this range. Then we have the dividends just paid as $2.1 per share. Next year's planned dividend is 2.205 per share. Tax rate is 30%, WACC is 9%, and the cost of equity finance, that is KE, is 12%. Okay. They are saying 21, what would be a suitable earnings figure to use for business valuation based on the PE ratio? Okay. Now tell me, can I use 33? Now earnings means what? The amount that is available for ordinary shareholders. They are telling me free cash flow available to the owner is 33,000. Can I use that as the suitable earnings figure? Do you think that 33,000 can be used as a suitable earnings figure or not? You can't, right? You obviously can't, because that is the latest free cash flow available to the owner after a salary payment. So this salary itself is a little bit of a mess, right? So we have to do this from scratch again. Okay. So what we will do is, based on the earnings per share, which is $7, let me get the earnings for the entire shareholding. Okay. So first let me calculate earnings. How will I do that? I will take the EPS and multiply that by the number of shares. So EPS is 7, number of shares is 5,000. So that will be 7 into 5,000, which is 35,000. Okay, 35,000. Is that the earnings? Still we haven't considered the fact that 60,000 was paid more. Okay. Now after this, in future, after he sells the business, he won't be paying 200,000. He will pay 60,000 less. Only 140,000 will be paid. So this 60,000 will also reach the ordinary shareholder, right? So 60,000, you have to add it to the earnings, but be careful. You can't just add 60,000 over here. Why? Because there was a tax impact that would have got created over here. If you paid 60,000 extra, you would have actually saved on taxation. So we can't forget about that impact. So let's take the after tax impact of this 60,000. Okay, so I'll take it over here. 60,000 into 1 minus the tax rate, which is 30%. So the actual benefit is only 70%, which will be 42,000. So this 42,000 in future it will reach the ordinary shareholder. So in addition to this 35, I can add this 42 as well. So 35,000 plus 42,000 will be 77,000. So that will be the earnings figure. Okay, take it down. It was not given directly.
When are we deducting 60,000?
Which 60,000 am I deducting? Adding.
200,000 minus 60,000.
Because now say you were the owner of the business. You were paying yourself 200,000. But now after you sell, now somebody else will buy, that person won't be the owner, he won't be the manager, So he will take another person and hire him as the manager. Now that person's salary, we won't give the same 200,000. Earlier I gave it to you because you're the owner, you can decide. But in future, we won't give 60,000 extra because you can see they're saying 60,000 is more than could be reasonably expected for such a role. So the new person who comes in, we will give him maximum 140,000 because that's the market rate. So the remaining 60 will end up going to the shareholder. It won't come as a salary for the manager. Okay, right. 22. If after taking other factors into consideration, they are saying suitable earnings figure of 50,000 is determined. So I know the actual earnings is 77,000, but they are asking me to use 50,000. So here the advantage is, even if in the previous question you were stuck, you are not carrying forward any answer to number 22. You can just continue because they have given you a figure to assume. So 50,000 is the earnings figure. Consideration, I'll read again. If after taking other factors into consideration, a suitable earnings figure of 50,000 is determined and unlisted companies are generally to be considered 20% less valuable than listed ones, estimate the total value using the PE method. Okay. Now, if you are going to use PE ratio, the market value will equal to the PE ratio into the earnings figure. That's the equation. No? I hope you agree with me. Okay. Now earnings, they have already told me it is 50,000. PE ratio also they are giving me, it will be between 7 to 11. Okay. So just a matter of figuring out the actual PE that you are going to use and multiply it with 50,000. Now whenever you have a range like this, take an average PE. Okay, so just a matter of taking 7 plus 11, dividing that by 2. So that will be 9. Okay, so if you have a range, if they have given you 9 directly, use it. If they give you a range, then take the average, right? So PE ratio will be 9. So market value will be 9 into the earnings figure, which is 50,000, which is 450,000. But be careful, because 9 is the PE ratio of a listed company. So if this company was listed, then the market value it will be 450,000. No two words about that. But they are saying usually unlisted companies are 20% less valuable than listed companies. So 450,000 is a listed company. So unlisted means it will be 20% less valuable. So you have to only take 80% of this figure as the market value of this particular unlisted company. So 450,000 into 80%, that will be 360,000. So that should come here. Okay. So every part, every line that they are mentioning, you have to focus on it. Because see, this is an answer, no, it's not even an MCQ. If you had just missed that part where you forgot about that 20% less, your calculations are there. In fact, half of the question you have done, you should ideally get at least 1 mark. But because these are MCQs, you won't even get that 1 mark for half of your calculation. So always read the entire question properly. Okay, it's a very simple point here. Okay. So that will be the 22nd one. Right? 23. If valuing a business using asset values, so all this while we were using earnings, right? When it's business valuation, you can either use your assets, you can use earnings, or you can use your cash flows. So now they're saying, suppose we are using asset values, when would a valuation using NRV not be appropriate? Okay. For the seller to use as a maximum price, the moment you see that itself, you should know that is wrong. Okay, because if you are using NRV to value, that is going to give you the minimum price, how much you can actually sell your assets for. So that won't give you the maximum price. Maximum price is actually replacement cost, how much it will cost to set up a similar business from scratch. Okay, so definitely A is not appropriate. The others should be correct. It's saying when the business is not a going concern, because if it's not going to be a going concern, the maximum we can get is the value of the assets. So the net realizable value will be considered fine. Okay. For a purchaser who immediately wants to break up the business after purchase, you don't want to run the business, you're buying it and selling off the assets. We call it asset stripping. Okay. If the business is a property investment company, you're just buying the business because you want the building, you don't want the business. So wherever you purchase a business without having the intention to run it, NRV is a good option to figure out the value of the business. But if you're going to run the business, then it is only the minimum amount because the business itself is worth more. Okay, so that is why A is not appropriate, because NRV is the minimum price, not the maximum. Go through all of this. We went through it when we were doing the slides. Okay. Right. 24. Calculate the price per share using the dividend valuation model. Okay. So we have done this many times. I'll give you the equation here. Market price of the share should equal to the dividend D naught times 1 plus G over KE minus G. Everything that you need is given in the question. Okay, quickly take down the equation if you don't have it. Can you give me the market price of a share using the data we have here? Dividend valuation model equation is given to you in the exam. They are asking for the price per share, so they are asking for actually P naught. This is what you have to find. So if you have dividends and growth and KE, it should be relatively straightforward. I think everything is there except for growth. Growth, you have to decide whether you are going to use Gordon's growth model or extrapolating past dividends. Okay, right, so I have D naught dividend, which they're telling me it's 2.1. I just need to get the growth figure, right? So for growth, clearly I don't have any information to do with Gordon's growth rate, but I have current dividend and next year's dividend. Okay, so some 2 years dividends is given, so I can use the extrapolating past dividends method, right? So what is that? It will be the growth equals to the current dividend D naught over the dividend, 1 minute, sorry, not D naught, it's actually D1, current dividend over the dividend n years ago. Okay, so I'll just call that D naught over 1 over n minus 1. Okay, now in this case, since it is only 1 year, this n also will be 1. N is the number of years that we are talking about. In this case, it's only 1, so we can completely ignore that. So D1 will be 2.205, next year's dividend, divided by D naught, which is this year's dividend, 2.10 over 1 over 1 minus 1. So the growth will be 0.05, which is 5%. Okay, so usually, careful here, right, you might get confused. Usually in the numerator we put the current year's dividend, so ideally we should have put 2.1, but here we are putting next year's dividend because in the normal scenario we have this year's dividend and maybe a dividend 5 years ago. But here they have given me the information a little differently. They are giving me this year's dividend and next year's dividend. Okay, so because of that I don't have a choice. For the numerator I have to put next year's dividend, and the denominator I have to put this year's dividend, because denominator has to be the old figure. Okay, so that's why the future dividend is the numerator and the current dividend is the denominator. Okay, so there is a small change in this particular question. Right, so the growth is there, the dividend is there, just a matter of putting it into this equation. So dividend was how much? D naught is 2.1. Okay, so let me put it here. 2.1 times 1 plus 5% over KE, which they told me was 12%, minus growth, which is 5%. Put that in your cal, you get P naught, which is $31.5 B. Okay, so the way we calculated growth was a little different in this case. Because why? Because they gave us current year's dividend and next year's dividend. Usually they give current year and the dividend maybe 5 years ago or 4 years ago, which they didn't give in this case. Okay, so that is the 24th one. 25. Complete the following statements. Annual investment in non-current assets or ongoing directors' salaries or dividends or tax would not be deducted in a calculation of free cash flows. Free cash flow means the amount that is available to ordinary shareholders. Okay, so how do we calculate this figure? We will deduct how much we paid for non-current assets. We will deduct the director's salary. We will deduct tax as well. But we won't deduct dividends. Why? Because dividend is also a figure that is available for ordinary shareholders. Right? So when you are calculating free cash flow, non-current assets, director's salary, tax will be deducted. Dividends won't be deducted. So that will be the answer. Okay? Because dividend and free cash flow both is available to the ordinary shareholder. Got it? Right, so that is it for this question. So like I said, relatively easy. They could have complicated business valuation, but they've just simply asked you PE ratios and a little bit of the dividend valuation model. Dividend valuation model also, it was straightforward, just a small twist because they gave you the following year. Now since you did this question, they can't twist it further. Okay, in your exam, either they will give you this way, the next year's dividend, or they will give you the normal way, the previous year's dividend. So it can't get more complicated. Okay. Right, so I told you in this section B, one question will most probably be from risk management. That is this question. You can see it is clearly something to do with foreign exchange. Okay, read through it and then we'll do the question. Okay, so it says Zigzag company operates in a country where the home currency is the dollar. Okay, so first fix that in your head. Home currency is the dollar. It has recently begun exporting to a European country and expects to receive 500,000 euros in 6 months' time. So it's going to be a receipt of 500,000 euros in 6 months' time. The company plans to take action to hedge the exchange rate risk arising from its European export. So what's the problem? In 6 months, when you get 500,000, exchange rate might have moved unfavorably. So when you convert it to dollars, you might get less than what we anticipated, or less or even more. Either way, we don't want that change. We don't like variation. Zigzag could put cash on deposit in the European country at an annual interest rate of 3% per year and borrow at 5% per year. So if you are going to do any dealings in euros, the interest rate for deposits will be 3% and borrowings will be 5%. The company could put cash on deposit in its home currency at an annual interest rate of 4% per year and borrow at 6% per year. Okay, so the deposit and borrowing rates for both the euros as well as dollars is given to you. So clearly something to do with a money market hedge might come up. Okay. Inflation in the European country is 3% while inflation in the home country is 4.5%. Okay. The following exchange rates are available to Zigzag. The current spot rate is 2 euros per dollar. The 6-month forward exchange rate is given and the 1-year forward exchange rate is also given. Zigzag is also considering the use of futures or option contracts, but the finance director doesn't feel that she knows enough about them to make an informed decision. Okay, so they have spoken about futures, options, forwards, and by the likes of it, a money market hedge as well. So basically everything to do with foreign exchanges here. So 26 is saying calculate the dollar value received if Zigzag company uses the forward exchange contract. Okay, so we are talking about a 500,000 euros that I will get in 6 months time. So obviously the forward that you are going to use has to be the 6-month forward, right? No point using the 1-year forward. Okay, so let's see how much we will get in dollars for this 500,000 euros if we went for a 6-month forward exchange contract, right? Now we are going to receive 500,000 euros. Tell me, you're in the US. Can you do anything with euros? Do you want the euros? You're going to receive it. You're in the US. Will you want to keep the euros with you? You want, right? You will try to sell the euros to the bank. So that means you are selling means the bank is going to buy from you. The bank always buys at the higher rate. Okay. So if you look here, you have 1.890 and 1.990. The bank will always go for the higher rate, which is 1.990. So 500,000 euros you have to convert using 1.990. So that will be 500,000 divided by 1.990, which will be $251,256. So that is how much you will get at the end of that 6 months. When you get the 500,000, you have already locked into 1.990. So the bank will have to buy it at that rate. They will give you $251,256. Okay. So that's that simple. Forwards are always easy. Okay. Then 27 is saying if Zigzag uses a money market hedge, what values will need to be borrowed and deposited today in setting up the hedge? Okay, whenever they talk about money market hedge, take my advice, do the entire calculation. If not, you will definitely go wrong. If you do bits and pieces in the marking scheme, you will see they are only doing portions. They won't do the entire hedge. But for us, it's better to stick to the entire thing because you won't go wrong. There is no chance for you to go wrong. Even if it takes a minute or two more, it's fine. Okay, it's worth it, right? So let's do a money market hedge here. Okay, so this answer is fine. Right, so if you are going to do a money market hedge, we need to have two columns basically, right? We will have today and what is going to happen in 6 months time. So let me put in the today's first. So we will have a heading saying today and what's going to happen in 6 months time. Now in 6 months time, I am going to receive 500,000 euros. Now if I receive, is it an asset or a liability? It's an asset. Then today I have to do the opposite. I have to do what? I will have to create a liability. Okay, you can either deposit. If you deposit, you are creating an asset, or you can borrow. When you borrow, you are creating a liability. So what I will do is I will borrow. Now I need to borrow euros. Okay, they told me that if you want to deal in the European country, annual interest rate is 3% per year and borrowing rate is 5%. Deposit is 3%, borrowing is 5% per year. So when I am doing the borrowing here for euros, I have to use the 5%, but careful, into 6/12. Okay, because it is only for 6 months. I am not going to do it for 1 year. Okay, so I will borrow at ideally 2.5%. So today basically I will borrow 500,000 divided by 1 plus 2.5%. The present value only I will borrow. So actually I would have ended up borrowing 487,805 euros. Okay, so today that's how much I have borrowed. Okay, now I am based in the US. I can't do anything with the euros. Even if I get this 487,805, it's of no use to me, right? It's of no use to me. So I will convert it to my currency. What is my currency? Dollars, right? So I will convert it today at the spot rate. They told me the spot rate is 2 euros per dollar, right? So that will be at 2. So 487,805, I will divide it by 2. Okay, so I will get to hand in dollars 243,903, which I will go ahead and deposit into my account. But then I don't have to do this part because that will give me 6 months, right? The question is asking me what will need to be borrowed and deposited today. So everything to do with today I have already figured it out, right? So I am going to borrow 487,805 euros and I am going to deposit $243,903. So what I am going to do today is very clearly there in the money market hedge, right? So let's see. Borrow 487,805 euros and deposit $243,903. So that is answer D then. Okay, because see here the borrowing, okay, the borrowing is for the euro figure, that's what happens today, and the deposit is for the dollar figure. So you have to make sure you select the correct answer. So today, after this, if you want, you can see what happens in 6 months time, but that is a waste of time, right? Because they are just for today's portion. Got it? Clear questions? Any questions online, guys? I've done the money market hedge. It's just that usually we will compare this figure that we get in the 6 months time, this figure we will compare with the forward and see what is happening. But here they are not asking that, they are just asking you how much you borrowed today and how much you are going to deposit today. The borrowing happened in euros, so I'll put the euro figure. The deposit happens in dollars, so that's why I get the dollar figure there. Okay? Right, take it down if you haven't, and then we can do the next one. Okay, right, so let's move on. Complete the following statements. The 1 year expected future spot rate predicted using purchasing power parity theory is what? Okay, so it's a repetition. I think they had already given me the inflation rates over here. Okay, inflation is there, spot rate is there. To get the future spot rate, you can simply use the equation, right? So the future spot rate will be the current spot into 1 plus inflation in the counter currency over 1 plus inflation in the base. So spot rate was 2, 1 plus inflation in the counter currency was 3%, and home currency was how much? 4.5%. 1 plus 4.5%. So if you put that, you will get the future spot rate, which will be 1.971 to the dollar. So 1.971 euros will give you $1. Do we have that answer? Yeah, here. Okay, that was straightforward. It's a normal purchasing power parity theory. Okay. So that's it for the calculation. So usually again section B, every question has 5 no. In that mostly 3 will be calculations, 2 will be theory. Okay. Right. So now let's look at the theory. They are saying, which of the following statements about the use of a futures contract for zigzags hedging requirement is true? Now, if you are talking about zigzag, what is the situation here? They are going to receive euros, right? They are going to receive euros in 6 months time, right? Now, when they receive it, they don't need the euros because they are based in UK, no? So what they will do is they will sell those euros and buy dollars, right? So they will sell the euros and they will buy dollars. That is what will usually happen, right? So if you, now this is the actual transaction, right? This is the actual transaction. Now if you are entering into a futures deal, guys, you have to do the opposite. Okay, so if you are going to sell euros, then what you need to do for the futures transaction is you need to buy futures in 6 months time, because you will receive euros in 6 months and you are going to sell those euros, right? So for the futures deal in 6 months time, the opposite should happen. If you are selling in 6 months, you have to buy the futures in 6 months time. Now, if you need to buy futures in 6 months time, today you need to sell futures first. Get it? Because the original transaction is what I have written in red. You are receiving the euros, you don't need it, so you are selling it in 6 months. Now, the futures deal has to counteract this transaction, right? So, if you are selling in 6 months, the future you have to buy in 6 months. If you are going to buy in 6 months time, today what you have to do for the future, you have to do the opposite. You will have to sell futures today. Okay, so I would have actually told you something how to remember it, but the logic behind it is this. Okay, so in this case it's a receipt, so you will go ahead and sell futures and buy it back at closeout. So you can see you are buying futures in 6 months, selling it today. Okay, so let's see which one is talking about that. A is saying you should buy euro futures and sell them at closeout. That's wrong. Closeout means in 6 months time. We have to buy in 6 months. They're telling us to sell. That's wrong. Zigzag should sell euro futures now and buy them back at closeout. That seems to be correct. Okay, but anyway, I'll just read the rest as well. Zigzag should buy euro futures now and also on closeout. No, you can't buy and buy today and again buy again in 6 months, right? If you buy today, you have to sell in 6 months. If you sell today, you have to buy in 6 months. So these two are definitely wrong. So the correct answer there is B. Okay. Take it down, guys, because that's the explanation. you might get confused if you don't take this explanation down. I'll just make one small change here. Sell, I'll just say sell euros. Okay, so then what happens to the futures is here. This is the futures deal. Always remember the transaction and the future should be opposite.
Then it's better to remember to get an asset, you will sell futures. To get a payment,
Yeah, you can remember that. In your slides, I have given it like that only. You have to sell futures today. Upsell. Because in 6 months you have to do the opposite that you are doing to the transaction now. In the actual transaction you are selling. That means in 6 months time for the futures deal you have to do the opposite, you have to buy. So if you are going to buy in 6 months, today you have to sell. If you sell today only, you can buy in 6 months. Okay? Right. 30 is saying, which of the following statements about the use of a currency option for zigzags hedging requirement is true? Okay. So here again, what are we trying to do? We are trying to sell euros. Right? So if you are going to sell euros, when it comes to options, there are two types of options, right? There is a put option and a call option. I'm sure you can remember. Put means the option, the right to sell. Call is the right to buy. Right? So let's see, if you want to sell, what do you have to do? A is saying zigzag should use a call option. Call is the right to buy, right? We don't want to buy, we want the right to sell. So can't be A. Zigzag should use, again B is also talking about a call option, so that is wrong. C is saying zigzag should use a put option. So that's correct, the right to sell on euros, as it gives the right to sell euros at a fixed rate at a point in the future. That seems to be correct. Because we have 500,000 euros, we want to sell it at a future date. If we can fix the rate today itself, that's good for us. Which option will give us the right to fix a rate to sell? A call option, not the put, because put option is the right to buy. Okay, so here answer should be C. I'll read the D part as well. Zigzag should use a put option on euros and it gives the right to buy euros. That's wrong, right? It's not the right to buy. A put option is the right to sell. So the correct answer there will be C. It's the right to buy. This is the right to sell at a fixed rate. Okay, so sell euros means clearly it has to be a put option. Okay, take it down, the explanation, it will help. Okay, got it, right? Okay, so that is the end of section B. Okay, so now we have section C, two questions. One is based on NPV, the other one is based on cost of capital. Okay, so we will do both of them, okay, after the break.